Good afternoon, everyone. Welcome to our Earnings Untangled webinar. We'll just give it 30 seconds and wait for everyone to come in, and then we'll get started. It's a pretty rainy day here in Sydney, John. Hopefully we can help to brighten people's day with some great earnings information. I hope it's not raining everywhere in Australia, but it's kind of nice to be inside for us when it's raining and all wet outside. So
gives us an excuse. We're not forced to be inside.
Gives me an excuse not to have to go out and exercise. Great. As everyone's just coming in, feel free to say hi in the chat. Let us know where you're tuning in from. We'd love to know where you're coming from today. And for anyone that can't join for the whole time, this webinar will be recorded and we'll be sending it out to you, and it will be on our YouTube channel as well. So even if you can only stay for half the time, you'll still be able to listen to the full recording back. All right. Well, a little bit of housekeeping before we get started, John, and then we'll get straight into the meat of it. If anyone has questions throughout the webinar, please feel free to put it in the Q&A section. So that'll be at the bottom of your Zoom screen. Feel free to chat in the chat, but if there's specific questions, please put it in the Q&A function, and we'll have some time for a live Q&A at the end of the webinar. So let me just share my screen and then we can get started. Sunny Townsville. Oh, lucky you.
Makes
all
it
right.
Being down here.
Yeah. Oh no, wrong slide. There we go. Don't want to let you in on the secrets too early on. All right. Can everyone see my screen okay?
Yep. Okay.
So welcome to our Earnings Untangled webinar. This is the first of our, I guess, earnings type webinars that we're doing, John. We've done a lot on kind of the basics of investing, ETF investing, but we thought it might be useful for people to know some kind of topical, timely information about what's happening in the markets for some of our favorite stocks or stocks that we're watching at the moment. So before we get started, just a quick disclaimer that Superhero does not provide financial advice that considers your personal objectives, financial situation, or particular needs. And all investments carry risks, so please consider carefully before investing. Past performance is not indicative of future performance, and charts and graphs are provided for illustrative purposes only. Important for this one, obviously, we'll be talking about some of what's been happening at the moment or in the past for these companies, but what is in the future, we can't tell. So before we get into the companies themselves, John, earnings is something that's mentioned quite often in the financial world, and it kind of has this big importance, right? Everyone's always wondering what will happen at earnings time. But when I first started investing, it was something I had no idea about. So I wonder if you could just take us back a step and what is earnings?
Yeah, sure. So it is really interesting because you hear a lot about earnings season, and there's a season for that. So earnings, really, the basic meat of it is that it's the income that companies make. So they generate revenue. There's a number of different expenses that they have throughout the year, whether it's cost of sales, whether it's staff. But ultimately, what hits the bottom line. So that's what we're interested in when it comes to companies' earnings. What sort of financial gain are they making throughout the reporting period? And typically, you see companies reporting both in Australia and the US. They report quarterly. There's usually a quarterly update. But the sort of the real ones to watch are the half year and full year earnings.
Yep.
And that's also a time when companies pay dividends as well. They pay an interim dividend, which is typically at the half year results, and a full year dividend at the end of their reporting period. And I guess it really boils down to what the expectation is for earnings as well, in terms of how a share price moves.
Yeah.
Because a lot of the time you see companies report fantastic growth, massive increases in earnings, but the share price falls.
Yeah.
And I've had people call me over my career in investing and saying, whether it's Macquarie or it's CBA or it's BHP, saying, these companies had doubled their earnings, they made billions of dollars, but the share price fell 3% when they announced it. Why? And it really comes back to that expectation. What was the market expecting? Did the share price run up ahead of their earnings?
Mm-hmm.
Was Macquarie trading at $135 and the expected earnings was, X, and they came in at slightly under that, then the share price is obviously going to fall. So like a lot of things in life, it's all about expectations. And if you don't meet or exceed expectations, the share price can be impacted.
Yeah, absolutely. It's a really interesting one. I think when a company reports their previous earnings, they often also forecast, don't they, for the next 6 months or the next 12 months. So, they might say we had a fantastic year this year, but we don't expect growth to be as great in the next year. And so that can also impact the share price as well, because, a company softening its own expectations is often a sign that, investors will take that as well. So at earnings time, yes, it's looking to past performance, but it's also looking towards the future. And so companies can also often provide their own expectations of that, which then analysts and investors will respond on the back of as well.
Or there's market factors at play as well, and we'll get into that when we go through some of the companies. But obviously, with the pandemic, there's been a huge rise in e-commerce, and there's an expectation out there that won't continue as countries come out of lockdown. That under the current lockdown in New South Wales and Victoria, spending isn't as high as it was last year when we were all in lockdown. So there's expectations that get built into the share price, and then as companies report those earnings, those expectations play out in the share price as well.
Yeah, it's going to be quite difficult for a lot of these companies to lap the growth that they experienced in 2020, as it was the first lockdown as well. But we'll get into the details of that in a little bit. So we covered this off, John, briefly, but exactly when is earnings, or when is it normally reported for companies, both in Australia but also in the US?
Yeah, so there's a couple of times a year. So the Australian financial year is from the beginning of July to the end of June. So we run from sort of the midway through the calendar year. The US typically runs calendar year. So they run January to December. But then there's a whole bunch of different sort of companies that report under their own financial year terms, that they've made arrangements with the IRS or the ATO. So typically companies report full year earnings, for the end of 30 June, they'll report in August. So we're in the middle of Australian full year reporting season at the moment. And then half year reporting season is typically in February, late February, early March.
Yeah, and you can see there, so that's from the Superhero Instagram that just outlines for Australian companies, the majority of them are reporting their earnings around now in August. So that would be for their results up to the end of June. It obviously takes them a few weeks to, number one, get their earnings up to that point, but get all of the proper reporting and everything ready. And then they report around a month later. And it's similar for the US. So most of the US companies were around the end of July time that they reported their earnings, and we'll go through a few of those today as well. And just to let you guys know, I think most of you are Superhero customers, you have an account, but in your Superhero dashboard, there is a news tab. So you can see that there on the left, and that will show any company updates, results, presentations for companies that you follow or own. You can also see this under your holdings or your following tab. If a company's recently reported an update or has news, there'll be a little news flag that you'll be able to see. And that can actually link out there on the right, for example, was Bapcor's financial year 2021 results. So you can actually see all of that directly in your Superhero app. And that is the results presentation that they would have presented at their earnings call. So all of that information is available for you for Australian companies in the Superhero app. Currently, the same doesn't apply for US companies, but we are constantly looking at new ways to add value to the platform. So for Aussie companies, all of that information is available. And if you want to find that information for a stock that you don't hold or follow, you can just search in the Invest tab and you'll be able to see a news tab for that specific company as well. So if you're thinking about new companies, there's that resource there for you also.
US companies, that they don't actually report the same sort of way that Australian companies do. That level of disclosure is not quite the same. So yeah, we don't have company reports for US companies like we do for Australia, just because of the difference in the markets between the two countries.
Yeah. But there's also some really interesting information. You can see there, John, it's not that they just provide one financial, boring balance sheet or a profit and loss statement. There's actually a lot of really rich information in there, isn't there? Like they're talking about the types of customers they have, what different business models they have, particularly for some of the companies that you may not use, or even the ones that you do. You'd be surprised, and we'll see this later on, but as to how many different ways they get revenue, or how many different business units they actually have. You might know of one, but you might actually not know what drives a lot of their revenue. So it's a really great way to learn more about a company's business, not just the end number as well.
Yep.
So, and this will be really relevant when we go into the companies. We thought it would be good just to cover off some finance acronyms that you'll often see around earnings time and what these actually mean to investors and analysts. So earnings per share is the first one, or EPS. So EPS is calculated by dividing the company's profit with its total number of outstanding shares. And John, you'll take us into a little bit more detail around this. So in a way, EPS indicates the profitability of a company
at a per share level. Yeah, so it's the amount of income that is attributed to you as a shareholder. So if you own a share, it's $10, and they made the equivalent of a dollar. I have no idea what happened there.
Sorry, everyone.
I think our internet just crashed.
I think something happened. We're back. Sorry about that, everyone. Where were we at?
Back. So EPS is the amount of income per share.
Yep.
I don't know where you lost me. Hopefully you got all of that.
All right, let's move on. John, a share buyback. Now, this has been in the news a lot recently for one particular share, Commonwealth Bank. They announced this big share buyback. And apparently it was a good thing. I'm not sure. Tell us a little bit more about why a company would do a share buyback and what it can mean for a company. Guys, if you didn't get the full earnings per share information, it'll be on the slide when we do send around the recording, so you can get that.
So buybacks are closely linked to earnings per share. So the earnings per share is just to recap, it's the amount of income the company makes per share. And just to give you an example, if there were 10 shares on issue and the company made $10, there's $1 of income per share. So that's how it works. Now, it's really interesting when it comes to buybacks, And Warren Buffett is famous for buying back his own shares. A number of the big US banks and a number of the big Australian banks are famous for it as well. Telstra is also very well known for conducting buybacks. So what it means is the company has excess capital on its balance sheet, and what it decides to do with that, a company's management, a business's management is charged with allocating capital effectively to get a shareholder return. So if you've got $1 million, you want to invest that to get a better return. And when there's nothing for them to buy or to invest that in, they often turn to their own shares. And by buying their shares, those shares then get cancelled. So what they do is they reduce the number of shares on issue. So if you had 10 shares on issue, you made $10, you get $1 per share. If you buy back 5 of your shares, you now have 5 shares on issue, but you still made $10. So your earnings per share went up to $2 per share. Yeah. So it's increasing your earnings per share, decreasing the number of shares on issue. And that's exactly what CBA has done. Now, there's a whole bunch of complexity that goes into it. They're buying it back for less than the current share price, but they're paying it out as a dividend, which is fully franked. So you get a tax benefit. So if you are in a more tax effective structure where your tax rate may be less than 30%, you may get that sort of increased tax benefit. Yeah. But effectively what buybacks do is, and just to use the Warren Buffett example, Warren Buffett's famous for making very large acquisitions. He's buying railroads, he's buying manufacturing companies, he's buying insurance companies. But when there's nothing there for him to buy that he thinks is very good value, he's investing in himself. He's buying back his own shares. So he literally goes onto the stock market and he gets his broker, I think it's Goldman Sachs typically, and they go and buy a whole bunch of Berkshire Hathaway shares, and he spends billions of dollars doing it. And once he buys all of those shares, they cancel the shares and there's less shares on issue, so that earnings remain the same or they're growing or whatever. There's more earnings per share. Yeah, so the two are very closely linked.
Sure. And it is often those big companies, John, where, for example, a Commonwealth Bank, they are so big in Australia. They've got such a large a customer base. And I guess for them, it is more valuable to do a share buyback or increase the EPS that way, rather than, looking for other growth opportunities or just spending in growth buckets. And the last one we'll go through is just the PE ratio. So I guess what the PE ratio does is it matches the earnings and the earnings per share to the current share price. So it is often used by investors to determine the value of a stock and where it is in regards to the current share price. And you'll often see this talked about, John, in, I guess, growth companies particularly will often have a much higher price to equity ratio than, let's say, a Commonwealth Bank, a blue chip stock, or a stock that's been around for a longer amount of time. Yeah. And that's because when it comes to a growth company's share price, there's a lot of future growth backed into that price, right? Back to that idea of expectations versus reality. When it comes to a growth company's share price, people are expecting that their earnings will grow very, very strongly. And so the price, I think
it goes into the sort of the, there's knowns and unknowns. It's around the expectations. So people for growth stocks, they're happy to pay a higher PE, buy the stock on a higher PE because there's potential for more growth. When it comes to a bank, they typically trade around, the sort of the 12 low teens in terms of PE. And that's because they've got very sustainable, reliable earnings. Like every year, they're going to make X amount of money, give or take a small amount. Where something like Afterpay, for instance, they could double or triple or quadruple in a year. Therefore, the price earnings that they're willing to pay is much higher. But for some companies, PE doesn't really exist. You have to make a lot of those growth companies don't have the E. They don't have earnings. They're still making losses. So in some instances, PE ratios aren't aren't a very reliable metric.
Yeah.
But if you go back to buybacks, you go back to EPS, it all sort of flows through. If you have less shares on issue, you're increasing your earnings per share, you're increasing that E. So the price ultimately would increase because earnings is increasing. So you can have that sort of flow-on effect to a company's share price as well.
Yeah, and someone's just asked in the chat, what is a good PE ratio when looking to invest? That there is no one good PE ratio, right, John? Like you just said, if you're looking at, I guess, an income stock or a stock that's very kind of blue chip, you're probably looking on average at a lower PE ratio, so around that 12 to 13 that you said, John. Whereas if you're looking at a growth stock, it really is all about the expectation for future growth. Yeah. So, you'd probably be better off looking at the likes of company plans and what they're doing with their customers, I guess, as opposed to their current earnings, because there's a lot of future expectation that people are looking at. Negative PE. So John, I believe that's
negative PE. I mean, it's kind of not really. It's not really. You can have a negative PE, and I believe on our platform we do actually show negative PEs, but it's basically where earnings are negative. So obviously that doesn't have a flow through to the share price, but if earnings are negative, it's basically saying that this metric isn't one to really base an investment decision off, and it's not one as a single metric to base an investment decision off either. But what you have seen over a number of years is the banks typically they fluctuate between around 10 times the PE ratio up to around 15. And you see them sort of trade in that range. So as the share price, it doesn't mean the share price trades within the range. It means the earnings do. So CBA up over $100, it could have a lower PE now than when CBA was $50. It really just does come back to the PE. So it does depend on the company. It depends on the reliability of their earnings. It depends on their growth. It depends on the macro environment, what's happening globally. And when it comes to the banks, if you look early last year, when everyone thought everyone was going to default on their mortgage, and there was a huge amount of payment terms set up by the banks. They weren't going to generate any income again. They were going to make huge losses, and that turned around very quickly. So the share price did as well, and you would have seen the PE ratios turn around very quickly as well.
Yeah, so it really depends whether you're looking at a growth company or more of value-based investing as to what number that you're looking at. So it's important to know your goals before you then go in and make investment decisions based on a certain number, I would say. All right, now we get into talking about some companies, which I'm sure everyone's excited for. So, John, Apple.
Apple.
Take it away with this one.
Yeah, so Apple's a fascinating company. It's really exciting just to see the quantum of revenue, of income this company makes. It's insane. $81 billion. That's from one company. The interesting thing when we're talking about PE ratios, Apple's typically traded on about a 10 times PE ratio. So its earnings, even though it's got massive year-on-year growth, the market doesn't expect it to produce the same growth next year. So they price it on a lower PE. But every year they exceed growth expectations. So I don't understand it. The interesting one for Apple though was last year we had the pandemic, we had the global lockdowns, e-commerce went through the roof, and Apple just saw this huge increase in earnings. And there was an expectation that they wouldn't be able to post the same sort of growth again this year. They have come out in their latest earnings report. They've growth is still on.
iPhone sales. iPhone sales, just to mention, so you can see their revenue growth 36%, but iPhone sales were actually up 50%. So they're just going from strength to strength. And I think the thing with Apple that I find, John, most is you can see it so clearly in life. Some companies, it's harder to see where their growth's coming from, but ask 9 out of 10 of your friends, and what phone do they have, right? Like, you just see it so clearly. And then within their ecosystem, not only does everyone have an iPhone, but they also want the Mac, and they want the AirPods, and they want, they've just created this customer life cycle that is so strong and such a strong brand identity.
And just, the size of the business, I think their AirPods business is bigger, has more revenue than any of the tech stocks listed on the ASX. So it is a behemoth. But yeah, people want their products. They bring out a new iPhone, everyone wants the new iPhone. You upgrade to the new one as part of your plan or whatever it is, and everyone sort of keeps going. So they've got this, it's almost a recurring revenue base, as well as all their other products around streaming music and videos and things.
Yeah.
So yeah, fascinating one. It is the most popular US stock on Superhero. And it's definitely one to keep an eye on, and I think one to watch over the long term.
Yeah, it was interesting that I'll just mention this and then we'll move on to the next one. But the share price actually did drop slightly on earnings day, and that was actually because during the earnings call, the executives of Apple mentioned that there may be some supply chain issues. So I thought that was an interesting one because, like we said, they're posting these amazing growth rates, but if something is mentioned that may affect those growth rates in future, investors can, respond to that quite quickly sometimes. But it doesn't necessarily mean that that's going to continue. It's just interesting that,
it's around expectation setting though.
Exactly.
So what they now have is there's an expectation that there's going to be supply chain issues. When they come out on I think it's the 6th or the 7th of September, they're announcing new products, supposedly. Yep. It's all a mystery until the day. But when they come out on that day and they say, right, we're ready to ship, 10 million iPhones on the first day, then, you see that reflected in the share price again as well.
Yeah. So next we have Tesla. Now, another big tech behemoth in the US, but a little bit different to Apple in the sense that it truly is, I guess, a growth stock, or people are definitely looking for really strong growth from Tesla. And they had their biggest quarterly earnings ever. So their revenue was nearly at $12 billion and their year-on-year revenue growth at 98%, which is extremely strong. I've got some numbers here that they had 201,000 electric vehicle deliveries in the quarter, which is bigger than they've ever done before. And I think this to me just reflects a trend, not only for Tesla, but also, a consumer trend towards electric vehicles and towards new sustainable products. Their earnings per share came out at $1.45, and you can see there how much their electric vehicles actually make up of their revenue. So 10.21 billion out of 11.96 billion. So they truly are the dominant ones in the electric vehicle space. John, do you have any reflections on Tesla?
Yeah, well, I think it's interesting. It's 10.2 billion in automotive sales. I know that they bailed out of a lot of Bitcoin during the reporting period as well, and then re-entered. So yeah, it's generating less revenue than some of the other car manufacturers. It's worth almost as much as all major global car manufacturers together. So is it overpriced? I guess that's the conundrum the market's in. There's a lot of analysts that think it's got a long way to go. There's a lot of analysts that think it is way overpriced. But looking at some of their technology, looking at the advancements they're making in electric vehicles and things, they are years ahead of their competitors. And yeah, where it goes to from here, I'm not sure. It is the second most popular stock on Superhero though.
It is good to see that their gross margins for their cars are getting bigger though. So for each car that they're making, they're actually improving on their, I guess, revenue to cost ratio, which is a good thing to see. that they're also, I guess, getting more efficient in what they're doing as well as just having growth. But yes, I think a lot of people, or the true believers in Tesla, really do think that it has a long, long way to go, even to where it is today, in terms of growing globally. And I think this is the last one for the US, and then we'll move into Australia, a very topical one at the moment, Pfizer. So all about the vaccine for this one. John, take us through.
I mean, you can see in the chart how it's gone. It is obviously, I think everyone in Australia is aware of Pfizer, famous for the COVID vaccine that has been rolled out here and globally. With such huge demand for that single drug, that is going to underpin their earnings for years to come. But Pfizer is a massive company. They are one of the largest pharmaceutical businesses in the world. They do a huge amount of medical research, and producing, the sort of the revenue that they're spitting out. It is quite significant, but they are a major global player. They haven't popped up and produced a vaccine just for COVID. They have been around for decades, and one of the biggest pharmaceutical businesses in the world, and posting close to 100% year-on-year growth in their revenue is quite phenomenal.
Yeah, the COVID vaccine has really, I think, boosted Pfizer into the spotlight, really, for retail investors. I find, like you said, John, they've been around for years. The COVID vaccine isn't the only thing they do by a long stretch. They've got hospitals, they've got research, they've got, lots and lots of different pharmaceuticals. But what I guess the media and COVID has really done has made Pfizer a household name, and really brought it to the forefront of people's minds when they're thinking about investing in healthcare or investing in the trends that are affecting us today, which, probably a couple of years ago might not have been the case. I can't remember the brand of any other vaccine or needle I've ever gotten. When I was thinking back, I was like, isn't that amazing at how globalized media and the spread of information is really filtered through into the stock markets and what people are looking for to invest in, because people can see it and they can hear about it in their everyday lives. So we touched on this one earlier, John. Now on to Aussie earnings, which are happening kind of at the moment. So we'll go through a few that have already happened, and then there's a few on the list that are coming up in the next few days that might be ones to watch.
Yeah, so CBA is an interesting one. Given we did touch on it earlier, but given the sort of the steep drop last year in expectations around their earnings, and then seeing the rapid sort of improvement in bad debts, or lack of bad debts was what really put a rocket under the share price, going to all-time highs. But seeing the amount of profit growth was an interesting one as well. So what banks typically do is they typically take a whole bunch of capital and they set it aside for bad debts. That comes off earnings. And when their bad debts don't come through, what they can do is they can pull some of that money back out, and it actually falls into their income line. So they have seen very strong profit growth. The banks typically, the market's sort of saturated. It's full when it comes to mortgages, which is their core business, but the market is sort of full. So there's not a huge amount of growth to be had. It's really sort of taking business off the other banks. The only growth that you're really seeing is the growth in house prices, and then therefore mortgages are bigger. But they have been able to post very, very big numbers in terms of their income. And that's led them to being able to pay a pretty high dividend, as well as buy back a huge amount of their own stock to increase that earnings per share number.
Yeah, house prices definitely did not slow down in 2020, and there aren't any signs of it yet. So I think Commonwealth Bank and probably the other banks are loving that.
Yeah, so typically not one that sort of younger investors look at. Banks are kind of boring. They are seen sometimes as the enemy as well. just with everything through to their customer service, some of the charges that they apply to everyday savers and things.
Yep.
But they have performed extremely well, seeing CBA up at the levels that they're at now.
Yeah.
And given they have come back a bit, but there's multiple areas to look at when investing. You don't necessarily need high growth stocks to generate capital growth in your portfolio.
Yeah, and income. You can see that they do pay out a pretty good dividend, which some of the growth stocks don't pay a dividend at all. So yeah, when people are thinking about diversification, I think that's really important, just to know the differences between different stocks and different benefits that they provide as well. And it also just mentioned that, yes, Commonwealth Bank, home loans, they're kind of saturated in that market, but there's a lot of other innovation going on in banks. The likes of them acquiring other smaller banks for new digital technologies, starting their own buy now, pay later systems. I think CommBank, I forget what that is. It Step Pay that it's called?
Step Pay.
Yeah. So, they're investing in different e-commerce companies. There was one I remember seeing around this new startup called Little Birdie. And so, which kind of compares different e-commerce platforms. So I'd take a look at the company as a whole, not only their core, which I guess makes up the biggest portion of their revenue and their earnings, but there are other innovative ways that these companies can grow beyond what was traditionally their core function. So Sydney Airport. Now, we mentioned that some companies saw extreme growth during COVID. And I guess on the flip side of that coin, there were some that unfortunately had their revenues impacted in a negative way. We'll go through Sydney Airport, and we're going to actually look at Qantas, which is coming up as well. So interestingly, Sydney Airport obviously last year saw a dip in their expectations and their earnings as well. But that has unfortunately continued to 2021. So you can see their growth has still continued to decline. So minus 33.2% on last year. And, last year COVID had kind of started around Feb, March in Australia. So you started to see some lockdowns then, and then kind of went from there. But this has been the first full year of earnings that Sydney Airport have reported where their business has been entirely affected by COVID. It was interesting there that they have multiple revenue streams as well. So yes, there's aviation, but you can see a big portion of their revenue also comes from retail and things like property and car rental. And when you don't have people visiting the airport for aviation, you don't have people buying retail, therefore they're not getting rent. So it's really, unfortunately, this flow-on effect that affects Sydney Airport, not only in the plane space, but also as a property and infrastructure provider as well.
I mean, parking has always been a major income generator for Sydney Airport. You think about going and dropping someone at the airport, you want to park and go in, it's going to cost you a fair bit of cash. The fact that there's no one going to the airport, so aviation is still going, and there's been a huge increase in freight coming in. So you look at the freight numbers, it's up 3 times on 2019. So huge amount of aviation revenue still coming through, even though there's not as many travelers. But because there's not as many travelers, that's impacting the retail line, it's impacting the parking and transportation lines as well. Yeah.
So again, different revenue streams for these different companies. And it is amazing that they have been able to innovate, and there's huge growth. I mean, things like e-commerce have really impacted that freight difference as well. But the last thing to mention on Sydney Airport was that they received a takeover offer. Now that was in the media quite a lot. And that takeover offer was, I believe, around or just below what their share price had been before COVID, so pre-2019. And the share price did jump when that takeover offer was announced, because it was higher than the current share price. So investors were kind of, interested, and obviously someone was willing to value it at higher than what the current share price was. Now, Sydney Airport declined that first offer, but the share price, interestingly, has hovered around the same price as what it initially jumped to. So there's still, I guess, a lot of investor interest in this space. And I mean, John, I'd be interested to hear your thoughts. Sydney Airport, it's not going to go away in just a heartbeat, right? It's the core of really Australia's entire aviation industry. So I think.
Yes, I think on that one, it's really interesting to see such a massive offer coming through. It was a consortium of investors, including a bunch of industry super funds. You know, they're buying a strategic asset. It's a monopoly. There's only one major airport in Sydney. It's the biggest in terms of, in a normal world, it's the biggest in terms of traveller numbers. But they're buying it at the top of the market. Asset prices are the highest they've ever been. But to knock it back, share price stay where it is. There's been talk of more offers coming in. Look, I think it's a prized asset. I think it is a bit opportunistic given revenues are down. It'll be interesting to see how it plays out. But there's definitely value there. And when travel comes back, I think this stock will go from strength to strength.
Agreed. Now, just a few before we finish and go to question time that are coming up that I'm sure people are really interested in. So we've got Zip and then we'll go to Qantas, which are both going to report their earnings on the 26th of August. So firstly, John, Zip, this is one of the most traded, well, actually, they both are the most traded ASX stocks on Superhero. There's always plenty of interest in Zip. They've had a bit of an interesting year. You can see their year-on-year revenue growth is quite strong, and year to date they have performed quite well, but they have seen quite a volatile year, I'd say, John. They kind of hit highs around Feb at around the $14 mark. They dipped since then. What are you thinking around the Zip?
Yeah, so Zip's my favorite. It is an interesting one. It is very volatile. It's probably the most volatile out of all of the buy now, pay laters. But recently, you've obviously seen the Square acquisition of Afterpay, which is still working through. It hasn't finished, hasn't been closed yet. But there's sort of news circling around, what could that mean for Zip? Is it a takeover target? Are they going to be around in a few months or a few years, or are they going to be part of a bigger consortium? So that has created some volatility. But it comes back to e-commerce, what's going on in the e-commerce market, what's going on with competition globally. There's banks that have invested in Klarna. Klarna's come into Australia. PayPal's launched. Apple's launching a bunch. So there's all of these sort of competing forces that has created a lot of volatility. And because Zip is sort of the second tier player in the market, that does put question marks over, whether it's a takeover target, whether it's going to be impacted by competition, or whether it's going to stand out and become, a major global leader. Yeah. When it comes to their earnings, which are coming up this week, it's really going to come down to expectation. So what is the market expecting? That's either going to sort of, see the share price really rally or pull back. In Australia, there's a number of institutional investors that would have their own internal views on what they're expecting. It's also one of the most shorted stocks in the market. So it has a number of investors that believe it may go lower. They've sold stock that they don't own, believing that they'll be able to buy it back at cheaper prices. Someone's just said, why is Zip my favorite? You shouldn't get an emotional attachment to a company. I was actually involved in the listing of Zip back in 2015 and have been following the company all the way along. I think in terms of the broader Zip opportunity, I think it is really interesting. They're in a number of different countries. They're in the States. They bought QuadPay last year during the lockdowns mid-year. That business is now bigger than the Australian business. They're in Mexico, they're in the UK, they're throughout Europe, they're in Eastern Europe, they're in the Middle East. So huge global footprint, and building up the transaction volumes. I think it's a fascinating business in a space that has seen huge growth. Afterpay has been the standout leader, but I think there's a lot more in it in Zip. As they continue to build out their business.
I think something really interesting about Zip too. Zip have definitely had an equal focus on consumers or people like you and I buying a dress or a soccer ball, but they have an equal focus on business financing as well, and particularly in the small business space. So actually offering loans of kind of a higher amount than your $100 purchase to small businesses. So it's important, again, not to just think about what you might use it for, but also the other different business areas that they're pursuing. And like John said, buy now, pay later. Yes, it's been around for a few years, but it's only been around for a few years as well. And Australia really is a leader in the space. So we are kind of looked at as, and these brands, Zip and Afterpay, as the leaders in the space. And I wouldn't underestimate the impact of that in terms of the opportunities for growth there either. You can see that they've also had a nice rebrand, interestingly, in the last few weeks to align more with QuadPay. So they're starting to build themselves out as a bigger global brand. And lastly, Qantas. So John, we spoke about Sydney Airport as, I guess, the infrastructure play there, and particularly focused on Sydney. But Qantas, I mean, huge global player when it comes to aviation, and really Australia's baby, in terms of planes and the flight industry. They are expected to report a loss, down even from 2020, as well as we've seen, unfortunately, flights domestic kind of picked up for a little while there, and now with lockdowns across the country, that has diminished again. So it was interesting that Morningstar thinks Qantas's fair value is actually higher than its share price today. So that's just one of the analysts' outlook on it. And I guess that really comes back to Qantas being such a strong brand in Australia.
There's such strong brand loyalty with Qantas as well.
Yeah.
And some people prefer Virgin. But when you get onto a Qantas flight, I don't know, there is that feeling of, I don't know, there is a feeling that you get when you get onto a Qantas flight, particularly when you're overseas and you get onto a Qantas plane, you feel like you are sort of coming home.
Yeah.
So there's a huge amount of value in their brand. They are one of the most recognized and most valuable brands in Australia. And you look at their earnings. So, we're talking about earnings diversification around Zip. We're talking, around earnings for diversification for Sydney airports. When you look at Qantas, they've actually got quite a diverse earnings base as well. And their most profitable and highest revenue business unit is their domestic business unit. So flights have been cut massively. But Sydney to Melbourne is, I think, the second busiest, or it was
flight route in the world.
Busiest flight route in the world, and it was one of the highest margin flight routes as well. So you can go and book a Jetstar flight for $30, or you can fly Qantas for $200. And some people sort of go, well, why would I do that? But every Qantas flight to Melbourne or back to Sydney was always full. This is pre-pandemic. So their brand loyalty and the margins that they build into their pricing has allowed them to weather some of the storm. As they did turn back on, and you saw during the pandemic last year, there were a number of issues with Virgin. They went into administration. They did come back out. But that would have impacted their brand loyalty as well, and you would have seen a huge amount of people looking not to take risk on a company that may potentially fall over, and they decided to fly with Qantas, just because there's assurance that they're always going to be there, you're always going to get your money back, or you're always going to be able to rebook your ticket. So that has allowed them to maintain, revenues. They're obviously down significantly, and they will make a loss. But once things turn back on, I think Qantas is probably the leader, or will be the leader in that sort of that reopening trade on the market. We did see it last year. We saw Flight Centre and Qantas really pick up as borders started to open domestically. It'll be interesting to see what happens when they do start talking about opening international borders as well. Qantas would likely be a major beneficiary of that.
Definitely. And I think their frequent flyer program too is just always one to remember. That really does touch every aspect of Australian life. It feels like whether you're buying a new car or buying your groceries or signing up to Netflix, you can probably get a Qantas points bonus somehow, right? So they definitely filter themselves into all areas of life, not just flying. And I think that's really solidified their brand presence as across every category of purchasing as a really strong benefit and thing that people really, really value for the future. So that will really, I think, hold them in good stead as people do continue to return to flying, and they've got all these points built up that they haven't spent in a couple of years because they haven't been flying. It'll be interesting, to see how that affects flight choices going forward as well. So we'll leave this up on the screen, guys. We did mention a couple of US stocks throughout the webinar, and US stocks, we've had it on the platform for nearly 2 months now. But if you did want to see how to trade US shares on Superhero, we'll leave that there. But if anyone did have any questions, feel free to pop those into the Q&A function now. And I'll just see if I can bring it up. I might not be able to actually. Let me try. I may need to.
I've got someone's written one here, which is an interesting one. They've invested in AstraZeneca and not Pfizer, due to the fact that AstraZeneca is producing vaccines at cost, as opposed to Pfizer, which is making huge profits, and they'd be more comfortable in that versus potentially making lower returns than investing in a company that is making higher returns for what may be perceived the wrong reasons. Really interesting, I guess, moral view there. And we see that across ESG investing a lot as well. Would you prefer to generate a lower return if you were investing in, clean energy versus oil and gas? And it's a fascinating topic. I think AstraZeneca is not going to go out of business producing vaccine. They've got, particularly in Australia, they've got a very big licensing agreement with CSL and the Australian government. So they will be making significant revenues. I'm not aware of the underlying business metrics of their agreements. But it is interesting to see how people do consider how they invest.
Yeah, I think that's a really important one. We talked a lot about numbers throughout this presentation, but really before you go into the numbers, you want to think about who you are as a person, what values you hold, and that really should be reflected, or you would hope it's reflected in your investing. And I think people are becoming more and more aware of that. Interesting point there on ethical investing generally. It's something that we talk a lot about, John, as well, in terms of your super, right? So we've launched Superhero Super, which you can find out more on our website. But to us, a big part of that is actually knowing what you're invested in, whether that's with your trading portfolio, but also with your super, and not just giving it to someone and letting it sit there, but actually taking an active interest into who the company is, what they do, and different ethical factors depending on what those are to you. So whether that is that you don't want to invest in fossil fuels, or whether you have quite strong views on animal rights and those kind of things, I think it's important to look at before you make an investment as well.
Another question.
Yep.
Yeah. What are 3 tips for new investors when assessing growth shares? That's a great question. I think, I'm going to be careful not to give you advice, but I think the things that you need to look out for when you're assessing any investment is really understanding, if it's a growth stock, really understanding what sector they're in and where that sector has to go. So if you're investing in a very sort of small segment of the economy that has limited capacity, you may invest in a company that's got huge growth, but they're going to sort of cap out at a certain size. So you want to make sure that the company that you're investing in has got a huge market opportunity. I would say that's number one. Rach, jump in if you got any other tips.
Yeah, one that I often like to look at is barriers to entry for competition. So, if you've got a company that they're the first one to market, I think buy now, pay later is a perfect example of this. So you've got someone that might be first to market and they achieve huge growth initially, but if their barriers to entry can mean a number of things. That first mover might build such a strong brand, like we've seen with, for example, Afterpay and Zip, that it is hard to catch them. So that is one barrier to entry. It's brand building, and being a first mover can be great for that. But you also want to look at things like their technology and their structure to say, how easy would it be for a new player or an existing player, whether that be a bank in the example of buy now, pay later, to create a copy of that or introduce that kind of product as well and take that market share back. So you really want to find companies that are truly doing something different, disrupting, and potentially things that are harder to catch or harder to compete with. It kind of builds a moat around that innovation in a way.
The third one I'd say would be, whilst it can be difficult to know management, but I'd do some research on who is leading the business you're interested in investing in. Management is a big part of the business that you're putting money into, and understanding management's goals will lead you to understanding where the business is going to go. So if you can listen to a podcast with the CEO speaking or the founder speaking, do some research into who is actually running the business, and that will give you a good idea of what their business model is, but also their aims, their goals, their objectives behind the business as well.
Yeah, there's a lot of interviews you can find out there. I know, John, you and I both love Equity Mates. We listen to them, and they often do CEO interviews. So podcasts are a great way. There's plenty of information on YouTube as well. Hopefully in the future we'll be able to get a few CEOs on to chat to you as well. But yeah, podcasts and things like that are a great way to go and look for interviews with CEOs that will really give you an idea of where the company's headed, not just on the numbers, but their actual vision and the why behind their business as well, which is really important to remember. John, before we finish up, maybe just one more question in the Q&A. I'm not sure whether you can jump in there. I'm having a bit of trouble clicking in just in the Q&A function.
Let's have a look. Let's have a look. There's lots. There's a couple around future developments on Superhero. We're always working on the platform. There's a huge amount in our roadmap. We've recently launched US share trading in early July. Late July, we launched Superhero Super, which is a retail super fund, which allows you to invest your super in a range of ETFs and shares, or you can auto invest. You can set up a portfolio and auto invest your super. You don't need a self-managed super fund to do it. It is an APRA-regulated fund that you can roll over. Super easy to sign up to. I do recommend you read the PDS before doing it, but there's a huge amount of functionality that will roll out over the next few weeks, months, and certainly well into next year as well.
Yeah, definitely. Maybe the last one, John, just before we go, and are expectations based on the company's planning? We just answer that one. I think we went through it. But...
Yeah, so I think expectations are made up of a whole bunch of things. So it's made up of what the company says about about their business. It's made up about what analysts think or major investors. It's made up of what's going on in the world as well. So if you take let's think of one. Treasury Wines, for instance. So big wine manufacturer based in Australia. Revenue could have been growing. They could have posted very good earnings, but there's a huge amount of government regulation that's come in China, which is going to impact their future growth. So that's going to impact their expectation around their earnings. But the company might say, we think it's going to have a 20% impact to our earnings. The market might think it's going to have a bigger impact based on what is happening outside of the company, but that impacts the sector. So expectations are made up of a whole range of different things, and you would make up your own expectation as well on where you think an investment is going to go. So if you're going to invest in something for growth, then you're going to expect that company to go from $1 to $2. Based on whatever that underlying business is doing. So, and that would be based on a whole bunch of different factors. So yeah, it's not based on exactly what a company says. It's based on a whole range of different things. So it's important to understand what the company's doing, what management's goals and expectations are, but also doing some research around what's happening in the industry or globally that may affect that company as well, for good or bad reasons.
Yeah, definitely. And someone just had a question there around an earnings calendar in Superhero. We're always looking at new features to add to the app, but our Instagram at the moment is where we actually do daily market updates, and we publish an earnings calendar. You would have seen it on one of the slides there, where you can see some of the biggest companies or most popular on Superhero and when their earnings are. So I'd say for now, head to the Instagram. There are plenty of resources out there that will give you a calendar of when all of the earnings are, but great feedback. And yeah, we're always looking at ways to make sure you're informed. So we'll take that on board. I think we'll leave it there, John. We've gone over 1:30. But thank you so much, everyone, for joining us. We really hope that you leave a bit more informed about everything earnings-wise. And we will send out the recording as well so that you can go through it in your own time, and it will be on YouTube. But have a wonderful rest of your day. Thank you so much, John, for being here as well.
Thank you, Rach. And thanks, everyone. All the best.
Thanks, guys.